Steve Dudash is the president of IHT Wealth Management in studio with us. Steve, good to have you back. So today we've got this kind of rotation still happening in markets that really began in September, favoring cyclical names. We've got industrials, banks. It didn't happen last week around the Fed's commentary for cuts, but it's back today. What do you think?
I think that one, you were just talking about Uber, watch out.
Yeah.
Okay, let's put that off to the side.
We'll come back to Uber.
Yeah. But you're seeing the semiconductors, you're seeing the companies that have gotten beaten up a whole bunch in the last few months or years, and they're starting to take advantage of it.
Yeah.
It's a risk-on environment. You were just talking about it a few minutes ago. This is an environment where I do not believe that the trade war is going to end in a disaster. I do not believe that interest rates are going to spike anytime soon.
Okay.
And I don't believe that the economy is going to pull back. And if you put those together in a normal environment, you see outsized market returns, even in the short term. And so that's what we've been seeing lately. We've been seeing the companies that have gotten hurt the most because of fear in the past, taking advantage of it and really starting to make some money.
So this is interesting because what you're basically describing is kind of this continuation of the so-called kind of Goldilocks situation.
And like that, yeah.
But there's also now in the backdrop, we had some rough economic prints. We just, I guess, need those to not get worse at this point.
Do you think they're going to get worse? I mean, I don't see an environment or a situation where that can happen right now, unless we had some massive turnaround in our unemployment numbers, which isn't going to happen, or you had some sort of external spike in interest rates or something that could really drag it down. All of the bad news has been around politics, trade wars and stuff. That's not real. I mean, that's just show right now. And the people who have been able to take advantage of that show, every time they come out and say that we're not going to work anything out with China, come on, that's not real. They say that, markets pull back 2-3%, jump on top of it over and over again. Semiconductors is the prime example of that. They got destroyed for a year or so there because of the fear that they were going to go out of business. I don't know about you, but I use my phone for everything. I think everyone out there uses technology more and more all the time, and those are driven by chips.
So this is interesting, I think, because your point here, because you've got chips where we just saw earnings season where a lot of them still have negative numbers on the revenue growth side.
Fine.
But the point is they got beaten down too much on some of the geopolitical concerns.
Overly.
The question, I guess, then for an investor is, how do you know when they've made back geopolitically driven losses? And how do you know when to go, okay, this area got overdone because of something that is kind of, intangible. How do we then figure out, okay, well, now they need to actually deliver on results?
Do they sell a product that people want, and can they make money selling that product on what they want? And I think we were talking about this before with like Netflix and stuff. You've got companies out there that sell a product and lose money doing it. I like Netflix, everyone else out there likes it, uses streaming videos and stuff along those lines. But they lose money doing it and they don't show a path to getting there. Semiconductors, they sell those things for a profit, for the most part, and they show a path on how they're going to increase their profitability. I don't care what industry you're talking about, those are the two crucial things. Do you sell something someone wants, and can you make money doing it, or at least show a path to making money on it?
Right.
You've got companies that lose money and don't have a path. You have to run away from those no matter what the environment is.
Yep.
But the additional politics that was driving down the profits, let's just call it, of the semiconductors, that is not a sustainable thing, and that's something that you can peel away from the onion and see where they're going to start making their money in the future and then jump on top of it. It's like that with any type of investment.
So what's interesting now is even though we've got this backdrop where the economy, the main driver of employment, the main driver of the strength in the consumer is still here.
Yes.
But what we're also seeing now, to your point, is some more volatility and big moves in companies that either aren't delivering on the profit side. We've seen IPOs just get pummeled this year.
Oh, that's just because they're all overinflated right now.
Software too also getting slammed.
Getting slammed because of things that maybe they shouldn't have gotten slammed to for the fullest extent. But yes, it's overvaluation. The IPO market is the best example of that, and that's why you're seeing so many of them pull away. Actually, I'm surprised that the oil one's coming out now. I'm blanking on the name all of a sudden. But you know what I mean? Like, this is not the environment you'd want to see an IPO jump
Talking
out.
Saudi Aramco.
Yeah, sorry. Yeah, completely blanking on it.
So Uber for this afternoon, how will investors sort of know how to look at a stock that's been, as you point out, given a frothy valuation at the onset and say, okay, here's still something that's very disruptive that maybe I want to invest in the tech. How do you know when the opportunity presents itself? Is there a point where you look at Uber and you go, all right, this thing just got too killed on price, despite being this huge disruptive force?
Do they have a product that people want? Yes. Do they have a path to sustained growth? No. Do they have a path for sustained cash flows? No. They've got a massive problem that's coming down the pipeline, and that's when automated things come out. And there's a lot of companies that are dabbling in there. But as that comes out, that immediately hinders their market force. What's their driver to it right now all of a sudden goes away. So they either have to come out with their own automated driver, which I would bet other companies are going to come out before them just because they have more money and they have the ability of doing it, or they're going to become obsolete. I have a massive concern with any of those ride-sharing companies right now because of that long-term sustainability of what their product is.
Right.
Is going to disappear. They're going to have to change company. Can they change their company? Maybe. I don't know that. But the company that it is today will not be the company that it is in 5 years.
Yeah, all right.
It's impossible.
Really interesting. Now, part of the other section of this market that's been doing well with this kind of turnover the last couple months, the banks, the energy companies now recently as well, finally getting some life. Do you think this continues, or do you still just want to buy consumer-related names? Do you want to go as far to make a bet on cyclicals?
I like cyclicals right now, and the energy sector, I do believe in. I've been saying this for quite some time. I do believe that long-term sustainability in the energy sector, they got really hammered and never rebounded to the extent they should have. Financials are a different story. Financials have a problem.
Okay.
A year ago, everyone on this show, everyone who watches these shows thought interest rates were going up. Nobody was predicting 3 rate hikes or 3 rate cuts this year. Nobody. So you had a whole industry, including the insurance industry, that was banking on the fact that interest rates were going to go up and they were going to make their profitability, which you know how they make their profitability on that, and it's gone the other way around, and that is going to squeeze them because of what's going on overseas. I mean, we've got half of the debt in the world is negative right now.
Yeah.
Greece issued debt at a negative rate of return. A company that was about to default 3 years prior is now issuing negative rate government bonds.
Yep.
Do you think their government processes have gotten better in the last 3 years? Because I don't.
Yeah.
So
the banks still have those headwinds.
They've got massive headwinds right now, and headwinds that I don't think any of us would have believed were going to be in place 12 months ago.
Now, if Jay Powell came out and said, look, I've put the brakes on the cuts, which he effectively did, but he also said I'm putting the brakes on hikes too, then is that enough for the market to understand that maybe that worst of the margin contraction for banks is behind them? Because that industrial and kind of reflation trade that's been creeping in lately, it sounds to me like you don't really believe that maybe that's going to be something that lasts.
I don't see any mathematical reason why that will last right now. And we were just debating this today in my office with a bunch of our committee people about interest rates. And it's not very believable that interest rates are going to rise anytime soon. Not because we don't want them to rise, because I bet you there's a lot of people in the Fed right now that want interest rates to rise. But because when you have government debts across the world at negative or zero rates, it's hard for us to have that much of a dispersion from them. It's hard for us to jump that far ahead from where they're at without not artificial, but pressures pushing our rates down.
I see.
I don't believe our interest rates needed 3 rate cuts. Okay.
Right.
But I don't believe we had a choice because we had such a spread.
Sure. Now, last point is, if you're not ready to be sold on this kind of reflationary kind of bank type trade,
I am right now.
What about the trade that's happening in consumer stocks? It still seems to be one that's expressing economic hope and economic optimism, right? Just maybe of a different variety than, say, banking on yields blowing out to the upside.
I agree with it. I mean, consumers are spending. We're all spending money. The economy is doing pretty well. People are employed. We're actually starting to see some wage growth. There's not a lot of reasons to believe outside of massive things that could happen, just like wars or whatever. But there's not a lot of reasons to believe that our economy, our consumer spending, is going to drop anytime soon. It would take a lot of macro events to change that format where we're at right now. So to believe those are going to slow down, I don't see why that would happen right now in this environment. I do believe that our economy's well. I do believe, like we said in the beginning, that we are in a risk-on environment and we should take advantage of it. The people that are afraid, the people that are pulling back because of fears of trade wars or whatever it is, are the ones that are going to be missing the boat on, and have missed the boat this year on a lot of things. We've been saying the same thing for months now and really have taken advantage of it.
Yeah, all right. Steve Dudash, I like it. Really good conversation here. Some economic optimism, but a cautionary tale on Uber, and a good reminder that we might hear a little bit about autonomous driving in the report as well. Steve Dudash, president of IHT Wealth, thanks a lot.